And let's just talk about those investments. Right now, if you were to advise one of these pension funds about where to put their money in terms of actually allocating the capital, you know, some people, there was a report out last week that says private equity has been a remarkable winner over the past 25 years. Other people will say venture capital, you know, but there's also all these fees that are built in, and you see so much of the money moving away, frankly, from hedge funds and some of these alternatives right now.
Well, the reality is that a lot of the asset classes that you could have had access to out there over the last 30 years have done really pretty well, maybe excepting the last two in public equity markets. But a lot of asset classes have done well. Public stocks have done well. Bonds have done well. You know, the alternative investment classes have done pretty well, net of fees, depending on how you look at it. They either kind of just beat the public investments or maybe just fall short. You know, the trouble is that we've lived through a great and amazing bull market in all of these asset classes. And what state and local governments are doing is they're assuming that bull market is going to continue indefinitely. And secondly, it just violates the fundamental principle of finance, which is that you can't assume that just because you did well taking risky investments in the past that you're going to get the same returns taking risky investments in the future. And that's what they're doing. And with bond yields as low as they are, they've ramped up risk, ramped up allocations to these alternative investment strategies. You know, some have rolled back a little bit in the last couple of years with, you know, CalPERS leaving hedge funds. But a lot of pension funds out there, the vast majority of them are still going way long in these risky strategies to try to target their 7 or 8% return. And it's just very unlikely that they're going to get there. And what does that mean for taxpayers? That means that taxpayers are going to get pretty soaked by this. I mean, if you don't want your taxes to go up, if you rely on public services, you're going to get squeezed, because a lot of cities and states and counties out there, they may be setting aside, on average, they set aside around 7.5% of their budget to pension contributions. And a lot of people say, well, 7.5%. You know, that's no small change, but it's not that big. It's not a major crisis. To stop their debt from growing, to actually claim in an economic sense that they're running a balanced budget, they really should be setting aside 17.5%.